Well, let's get to our first conversation now. Going by the latest data from the World Bank, which has revealed that foreign direct investment into Nigeria has plunged by 58.98% in the past 11 years. According to the Washington-based lender's annual report tagged International Debt Report, the country's FDI depreciated from $5.966 billion in 2010 to $2.447 billion in 2021. The FDI refers to the investment in the form of controlling ownership in a business in one country by an entity based in another country. Recall that foreign direct investments into Nigeria dropped by $325.82 million in 2 years, according to data from the National Bureau of Statistics. And despite the coronavirus pandemic that disrupted businesses across the world, FDI rose to $930 million in 2020. Well, a lot of figures here. Let's discuss this disturbing report with my guest, who is a fiscal policy partner and Africa tax leader at PricewaterhouseCoopers, is Mr. Taiwo Oyedele. Mr. Oyedele, thank you so much for your time and compliments of the season.
Thank you, Tolu. Compliments of the season to you too.
Yes, FDI is down again by 58.98%. That's talking about in 10 years now, 2010 to 2021. Now, was this expected considering all of the challenges that we've seen in this time, that we've seen along the line, talking about the 10 years we are looking at in question?
Yeah, thank you very much. I think, a good starting point is just to remind ourselves that every country needs investment. In fact, sometimes we don't pay attention to the fact that even though the US is the world's largest economy and the most developed by many benchmarks, also the US most times attract the most foreign direct investment. So everybody and every country needs investment. The second point is that it is almost impossible for there to be growth in any economy without investment. So investment is really critical to many things. Whether you're talking about your ability to generate employment, the ability for government to raise tax revenue, the ability for there to be infrastructural development, the ability for human capital development, and so on and so forth. So everything is connected to investment, to growth, and economic development. Unfortunately, many countries in Africa, including Nigeria in particular, need even more investment than the developed markets. Yet, over this period of 10 years, we have seen foreign direct investment increase around the world. In fact, just this year alone, in the first half of 2022, according to a report by the OECD, the foreign direct investment around the world increased by 20%. So unfortunately, as investment is increasing around the world, we are seeing a decrease in the numbers coming to Nigeria, which has to be that this is not because there's no money in the world anymore for investment. It has to be that there are factors that are peculiar to us that are not allowing these investments to flow in that direction, given that investments do have options about where they go, when they go there, and what they go there for. So if what they are looking for is not what we provide in Nigeria, those investments will certainly look elsewhere. And in fact, beyond even the foreign direct investment, which is the best form of foreign investment that you want, there's also the portfolio investment, which tends to come into the capital market, sometimes to government securities, but they do provide liquidity, particularly in the exchange market. And sometimes they then have to leave if the conditions and circumstances are not right. In addition to that, we also need to remember that there's also the domestic investment mobilization. So we want foreigners to invest in our country, but we also want our people to invest in their own country. Like they say, charity begins from home. What we have seen, even though that data is not covered by what the World Bank has released, is also the fact that even locally, we are not getting sufficient investment to be able to fund our development and economic growth. And this is very apparent. If you look at, say, the Nigerian capital market, the entire market capitalization of the stock market in Nigeria is barely $50 billion. That's not even up to the market capitalization of the largest company in South Africa. These are some of the issues, but it's not good news. It's something that calls for a lot of reflection, and even more than that, it calls for deliberate action to reverse the trend.
Indeed, some will say, let the FDIs come. I think that's the hot money. It comes in and everyone wants to get a share, get a share of it. But putting that on the side, I want to follow up with the fact that for anybody to invest money in any country, the monetary and the fiscal policies must be encouraging. What is your assessment of all of this, particularly at this time? It's weeks to elections or months to elections. Do you think that we have what it takes to bring in this money at this time?
Yeah, very, very good question, Tolu. Yeah, so this is one thing that sometimes policymakers and politicians in Nigeria tend to mix. They mix it up or they miss it out completely. So we can blame COVID-19, but it did not happen to only Nigeria. It happened to almost every country in the world. We can blame Russia for invading, Ukraine, but that does not affect only Nigeria. It affects almost every country in the world. In other words, every country is having to face challenges. Yet, many countries still attract a lot of foreign direct investment. So why are we not attracting as much? The answer lies in your question, and that's to do with the policy environment. Whether you're talking about monetary policy or whether you're talking about fiscal policy, trade policy, even regulation or over-regulation, those things play a significant role. First and foremost, investors want to be sure that their money will be safe. So safety of investment, even though there's a component of it that is hard safety in terms of insecurity, there's also a bigger part of it that is soft safety. If I bring my money here, can the money be safe? Can I be sure of the policies of government? Will they reverse the policies after I've brought in my money? What will happen to me if I want to take the money out? Will the monetary authorities allow me to buy foreign currency at the official rate to take my money back? A friend was telling me a few days ago who had advised a foreign direct investor who came to Nigeria about 10, 12 years ago, bought shares, very big percentage of a Nigerian company. With the dollars that they brought in, they converted to Naira and bought the shares. And now it was time to sell and take their money back. On paper, Naira has appreciated, or rather, the value of the shares has appreciated, and government says they have to pay capital gains tax on the shares. Even though when they converted it back to dollars, it was less than half of the money that they brought in. Those kind of policies, especially because to even buy the dollars to take the money out, they can't get from the foreign exchange market, official market, they have to go to the parallel market. Now, what you find is when you have this kind of policy environment that creates uncertainty, it will discourage investors because investors are not just looking for returns, they are looking for risk-adjusted returns, which means in addition to the returns that you offer them, they make an analysis of what is the impact of the risk in that particular environment, what is the analysis of the risk in the industry where they want to invest, and sometimes even to a very small component of that subsector. Now, if you think about it more recently, because of Nigeria's inability to raise revenue and the rising cost of funding our debt, we had our debt service cost to revenue ratio for the federal government cross 100% stretch mark. So all of that led to the downgrading of Nigeria's sovereign credit rating, whether it's Moody, whether it's Fitch. And because you are being downgraded, many of the investors who invested in your country before, especially for foreign portfolio investors, you may no longer meet the minimum standard they've set for themselves. So they then have to sell off their investment in your country. and that creates even more problem in terms of attracting investment. So monetary policy, fiscal policy, and even other policies beyond that are really important. Investors are used to dealing with uncertainties. The uncertainties they don't like are the ones that politicians and policymakers impose or inflict on themselves.
Just when you mentioned that, I'm thinking about airlines too that have not been able to repatriate, international airlines not been able to repatriate their funds because of the FX crisis, which is also something. But I don't want to really talk along that line because I know we've been on that route before. But what do you think? Can we open up that space? Opening it up, many say that operators might also take advantage of Nigerians, of those that would need the FX. What is the easiest way out? Because if we don't address the FX issues one way or the other, we will still keep making our market unattractive. What is your suggestion, particularly with regards to this?
Yeah, the FX issue is clearly a very big factor in whether we're able to attract foreign direct investment or not, or even foreign portfolio investors, whether they will look our direction. Even the airline you're talking about, the forex policy is a major component of the decisions they're having to make. Now, the reason for this is not that it's strange to investors that your currency can depreciate against US dollar. As a matter of fact, many countries in the world experience the same thing that we experience. Some people more intense, some people less intense. But even the UK, for example, there was a time that the pound sterling was almost at par, with US dollars. And that hasn't happened, I don't know whether in the past 40 years. So investors are okay with that. What investors are not okay with is the fact that you then create different windows and different regimes for different rates, and they're not sure what are the transparent rules for when to qualify for a particular rate. The fact that I have $1, or to get $1, someone gets it at 445, another person gets it at 750 in itself is a major problem that we need to address. Once we address that problem, you will see that all the sectors of the economy will open up because investments will flow in our direction. And what you're going to find is that this issue with the airlines will disappear. Now, the whole thing about whether anyone would abuse the loophole is because we have created loopholes. If there are no loopholes, there's nothing to exploit. When the exchange rate in Ghana at some point this year was one of the worst performing currency against the US dollar around the world, I did not hear about two different rates. There was one rate. And I was speaking to my colleagues in Ghana this morning, and they said the currency has started appreciating. So what we need to do is to harmonize the rate. Let the rate be determined by market forces, with the central bank intervening by selling or buying dollars as the case may be, and don't push any legitimate demand to the parallel market. Let all legitimate demands come to the official market, and you can use the fiscal policy instrument to regulate what you want to encourage and what you want to discourage by way of higher import duties, which is a fiscal policy tool. Without doing this, we're going to create arbitrage such that people who are making money and exploiting the system are the people who are doing the bad things. And those who are trying to do legitimate business and contribute to the economy meaningfully will struggle, from manufacturers who can't find FX to buy raw materials and equipment, to service providers who need to pay for a software to be able to do their services, and the list just goes on and on like that. We need to address that. And also, when you talk about policy uncertainty, from a fiscal policy dimension, we had the excise duty tax on tobacco, non-alcoholic beverages, and beer. And then government, after announcing that this is the rate for 2022, 2023, and 2024, started thinking about increasing those rates again. And then the question we're asking is, why do you want to create this uncertainty? Does it mean that people can't even take your words and take it to the bank? Once you have these kind of issues, not only is that sector that is directly impacted, will consider it too much risky for them, it will send a signal to the rest of the investment community that this is a country where the risks are just too high, it's unpredictable, and therefore don't come there unless you can't find somewhere else to go.
if foreign investors continue to exit the market now, staying with the capital market, and we see domestic players trying to hold, holding forth as they leave the market, what do you think that domestic players can run this market positively without the international players coming in?
No, certainly, the Nigerian capital market is too small to finance Nigeria's development. If you have an economy that is over 400 billion and the capital market is hovering around 50 billion, it's not deep enough. It doesn't have the breadth. It doesn't have the liquidity for you to finance Nigeria's development. You should be talking about, many countries have the value of their capital market is more than 100% of their GDP. Even South Africa, which is a smaller economy than Nigeria, at some point, their capital market was over $1 trillion US dollars, by the way. So our market is so small, and my take on it is that capital market is still at the seed stage. You should not start imposing all manner of taxes on it. Allow it to grow so people can raise the money there to be able to finance development. And when prosperity is commonplace, and we should have one company in Nigeria that is worth $50 billion in market capitalization. So government needs to nurture the capital market, because it's even very difficult now to be able to raise capital from banks because interest rates are rising and there's also inflation. And then you wonder, if you borrow at 25%, what business will you be doing to be able to pay back the loan and pay back the interest after having to cover a lot of rising costs from energy to transportation to inputs in terms of raw materials, and the list is endless. This is not the easiest of time. So government has to be very intentional in ensuring that all the ways that businesses can raise finance, whether it's foreign, whether it's domestic, whether it's the capital market, whether it's from the banking system, government has to enable that process, ensure that there's less uncertainty, ensure that the policies are predictable, and ensure the tax burden is not too much on those investors, so that at the end of the day, we can all contribute towards ensuring that this economy recovers and start to grow in a manner that is decent enough to lift people out of poverty.
So what more measures or what more necessary measures can be put in place to address this outflow and, of course, increase inflow? I know we've talked about some as we highlighted, but let's just highlight some of them as we wrap up this conversation in straight terms.
Yes. That's a good question, Tolu. So, and I know you mentioned it before. We said that we are not getting enough foreign direct investment inflows, right? Unfortunately, as we are not getting enough inflow, we're also getting outflow more than what we would desire, because many of those investments are leaving for different reasons. Some of them for the risk, some of them because Nigeria has been downgraded, some of them because they just feel that the environment is uncertain. Added on top of that is the uncertainties that we normally put on ourselves whenever we are preparing for elections. Sometimes we prepare for it as if it's a war. Now, in addition to that, we're beginning to see corporates asking the question about, should I continue to operate in Nigeria? Or should I move to another country, maybe under the African Continental Free Trade Area? I can still access the Nigerian market without being physically in Nigeria. In fact, I saw a newspaper report a few days ago that says almost more than half of fintech companies in Nigeria are thinking of relocating. So I call it corporate emigration. When that happens, not only are you not getting FDI, you are losing the little that you have. So what government needs to do is first and foremost to engage with those investors. And I think they put their issues out all of the times. Government needs to listen more. What are the pain points? Issues to do with over-regulation, issues to do with multiple taxes, issues to do with foreign exchange uncertainties, issues to do with the fiscal policy environment, issues to do with lack of clarity around regional integration and industrialization policy, local content. So those issues that will not even cost government money, but will be very meaningful and impactful for investors to bring them here, so that at the end of the day, their risk-adjusted returns is not only attractive, it is competitive. That's what government needs to do, and do so very urgently.
Well, I wasn't expecting anything less. I've been speaking to fiscal policy partner and Africa tax leader, PricewaterhouseCoopers, Mr. Taiwo Oyedele. Thank you so much for your regular contributions to us here on Business Nigeria.
Thank you for having me.